I think it needs a lot of training. It needs careful selection. I don't believe everybody can trade. My experience talking to people who are in banking seems to support that you just can't take anybody, intelligent people, you can't take them out of the universities and make them into stellar traders. It doesn't happen. So there is something that we bring to the party as traders that can't be taught. Yeah, but you've got the wrong population. We need to go back 200 years where something happened every 3 months. I'll show you Toy Story. You watch the action in Toy Story. When do you get a chance to pause for breath? You've got to find a generation who will sit there and wait, and wait, and wait, and wait, and then act when the setup comes. Because these setups don't come in steady flows. I think that would be the problem. Humans aren't very good at this sort of intermittent, intense study.
So you have one guy just doing.
Okay, well, why haven't you done it? You've been doing this 10 years. Why haven't you got someone? I don't think that animal exists, but we'll see. I think the machine idea is much better. I think a machine would probably be better at the approximate match. Yeah, because there's lots of examples of how we are sensitive to things that are out of kilter. And for example, if you take a vertical line and have another line that's just half a degree out, we would spot that. And anything that's slightly out of kilter would then get starting to be slightly uncertain. And I think a machine would say, well, I've got tolerances, but we're not very good at applying tolerances. That's our problem. And that's where you get the cold finger. It's not quite right. And getting people to trade when it's not quite right is the difficulty. And you've explored this with sort of preemptive trades, for example. Yeah, the first question I'd ask is, when did they do this? Because if you take US presidents, for example, or UK prime ministers, a bull run makes you look very good. And it's like trading the German mark. You just kept selling it, didn't you? So you have to look at market circumstances, because there are a number of things that define you, but one of them will define you is what happens when you have bad runs. Now, with Forex, of course, because it's so easy to go long and short, that's not as big a problem if you were a long-only fund manager, and the way the long-only fund managers cope with it is because they insist with their clients that they're actually following an index. They beat an index. Unless you're a hedge fund manager, of course, where you've got to get absolute returns, and they've all tanked, haven't they? They're in dreadful problems. But at least you don't get that in Forex, because you can always very easily go long-short the currency pairs. You don't get central bank intervention saying, well, I'm afraid we're not going to let you go short dollar-yen, which is what the Bank of England did with the financial sector for a while. You don't get that sort of interference. So this should be recession-proof. It's only been in the last 18 months or so. You could get to 5 minutes before non-farm payroll, put a buy order above market, sell order below market, 20 pips, collect your money and go home. Now, what they first started doing was gapping. And if you think about it, apart from Friday to Sunday, you don't see gapping in Forex, unlike in stocks. Now you see gapping. So if it's on my website. I don't know how you've seen the video about gapping, but if you have your stop there and the market's here, non-farm payroll comes out, the market makers will move it to there, and there is no intervening price quoted. So yours is still, your stop loss is still sitting there at, say, 50, and they say, oh, thank you very much, and you get filled at 100, minus 100. And so you've got to be very careful. I don't think anybody trades non-farm payrolls now. There's a whole industry, wasn't there, in retail? You searched on news trading, and there were hundreds and hundreds of these people. I don't know who they are. Judging by the way they talk, I don't think they were in finance. They just learned that you could do straddle trading, and that's gone. And so you have to watch out very much for gapping, which is why you should not really have a position going into numbers unless you have to, because if you do get gapped, you might find your stop gets filled not at minus 10, but minus 30, minus 50. If you want to, it's very difficult to get on a trading floor and film. I have been on a trading. I was on Lehman's trading floor, which is the size of a football field, and that was amazing. But if you want to get some idea of it, I've got a clip from 25th Hour of what's meant to be a sort of simulation of a trading floor on non-farm payrolls. And there's this classic thing where the guy's boss says, okay, you stressed? He said, no, I'm not stressed. And he's squeezing the hell out of a squeeze ball. And it just gets interesting. He's hoping that numbers will go down. And we've so far moved on from when I first started trading. 300,000 was the minimum the US needed for the economy to grow. And if it was down 50,000, you know, the dollar tanked. And now we're looking at second derivative. Oh, that wasn't quite as bad as last time, but it's still, you know, double-digit unemployment. And as you say, the market actually becomes numb to dollar news, doesn't it? And you find things that should be negative, it just said, we'll price that in. And so it becomes much more difficult to predict which way the market's going to go with a news release. It can be much more difficult. You'll get long periods of time where you'll get dollar negative news, and the dollar doesn't go down because the market said, well, we knew that was going to happen. You know, it was already sort of priced into the market.